Hey, welcome back to Finance Uncovered, the channel where we break down the money stories nobody bothers to explain simply. Today we are talking about something every investor eventually needs to know how to do, actually reading a company's finances. Let's get into it. Two companies. Same industry. Same year. Same height. One of them's still around today. The other one doesn't exist anymore. And honestly, the difference wasn't luck. It wasn't even the idea. It was hiding in three documents almost nobody bothers to actually read: the income statement, the balance sheet, and the cash flow statement. So today, let's actually learn how to read a company's finances. That way, next time someone pitches you something exciting, you don't just have to take their word for it. Okay, so here's the thing: every company, no matter how exciting the story sounds, is really just answering three questions with numbers. Is it actually making money? Does it own more than it owes? And is real cash coming in the door, or is that just being promised? Those three questions map straight onto the three statements we just mentioned. And look, this isn't about becoming an accountant. It's just about knowing where to look and what a red flag actually looks like. Let's start with the income statement. It answers one question: is the company making money? Revenue goes at the top, you subtract costs and expenses, and whatever's left at the bottom, that's profit or loss. Some people call this the P&L. Then there's the balance sheet. This one answers: what does the company actually own, and what does it owe? It's like a snapshot, frozen at one moment in time: assets on one side, liabilities and equity on the other. And they always balance. That's literally where the name comes from. And then the cash flow statement. This one's about whether real cash is actually moving, or if it's just accounting on paper. It tracks cash in and out, split across operating, investing, and financing. Here's the thing beginners almost always miss: though a company can technically show a profit on the income statement while actually running low on real cash. Because revenue can get booked before the cash is even collected. That gap. That's exactly where the cash flow statement earns its keep. Now, why do so many people just skip all this? A charismatic founder or a slick product demo hits you emotionally in a way three columns of numbers never will, and that's exactly why people skip the numbers and regret it later. And once someone's excited about a company, they naturally start looking for numbers that confirm the excitement and kind of explain away the ones that don't. Honestly, a lot of it's just jargon intimidation too. Terms like EBITDA or amortization sound complicated when the actual ideas behind them are pretty simple once you translate them into plain English. The goal here isn't to distrust everything. It's just to swap out "this feels right" for "here's what the numbers actually show," and then decide for yourself. Alright, let's get practical. A few numbers actually worth checking on any company. First, revenue growth. Is it actually growing, or is it flat, or even shrinking while the story says otherwise? Look at 2 or 3 years, not just one. Second, net profit margin. That's net profit divided by revenue. It tells you how much of every dollar earned actually turns into real profit after all the costs. Third, debt to equity ratio, total liabilities divided by shareholder equity. If that number's really high, the company's leaning hard on borrowed money. Riskier, especially if growth slows down. Fourth, and this one's my favorite, free cash flow. Operating cash flow minus capital expenditures. This is the actual cash left over after running and
And I'm
maintaining
just
the
gonna
business.
leave that right there.
Honestly, it's one of the hardest numbers to fake. And last one, current ratio, current assets divided by current liabilities. If that dips below 1, it can mean the company might struggle to cover its short-term bills. And where do you actually find all this? Publicly listed companies have to publish these in their annual reports, freely available, no special access needed. You've genuinely got no excuse not to check. None of these numbers guarantee a company is going to succeed. But together, they tell you whether the story actually matches the reality before you put in your money, your time, or your trust. And honestly, that's the thread running through everything we've covered on this channel. Bubbles form, companies fail, when the story outruns the numbers. Reading these 3 statements is how you make sure yours doesn't. Next time, we're decoding the 1987 Black Monday crash, the day algorithms paralyzed Wall Street. And if you missed how the dot-com bubble actually played out in real companies, that video's linked right below.